Hello, welcome to this May 31st, 2024 edition of FedWatch. I'm Brian Beaulieu, Chief Economist, ITR Economics. There's some interesting data that came out this month, and in summary, and I'll go through some of the highlights, but in summary, it shows an economy losing momentum. The consumer in particular is losing speed in terms of being a consumer. Their incomes aren't going up as much. In fact, the disposable personal income has really slowed to what amounts to a crawl in terms of increasing. All of which, this is the bottom line already, all of which tells us that, I would rule out a September decline in the Fed funds rate or other interest rates for that matter. Although the market, looking at Fed funds rate futures, suggests that they're really weighting it more heavily toward beginning in 2025, but I wouldn't rule out September yet. It's only about a 40% probability based on the futures market, but I'm thinking it could be higher than that, particularly since John Williams of the New York Fed recently said, inflation doesn't have to be at 2.0 for the Fed to start cutting rates. They just need to see a path there. And I think the slowdown we're about to talk about is that path that could allow those of us who would like to see an interest rate decline actually see it begin to happen. So personal consumption expenditures, PCE data came out, and you look at the total, it came in pretty good. For the last 3 months, it's up 5.2%, so that 312 is up a couple of ticks from the prior 2 months. But as I say, the devil is in the details. When we looked at the data, April data compared to March, and that month-to-month percent change, it was only up. Personal consumption expenditures were only up 0.2%, and that's really quite low for a non-recession year. I mean, we get negative years like during COVID and during the Great Recession and in 2000, negative month-to-month changes in those sorts of years. But to see only 0.2% is it's a wake-up call that things are slowing down. Durables side of personal consumption expenditures remain negative year over year. That data trend is in decline. Non-durables are doing better, but even there we saw some weakness on that month-to-month basis, although that 3-month moving total managed to hit a record high. In the services, if you look at the year-over-year comps, they showed continued strength at 6.9% on a 312 rate of change. But there again, when we broke it down and looked at the March to April change, it was just barely normal. And the only reason the rates of change were as good as they were is because last year was even weaker than the rise this year. So we may be seeing some, certainly on the good side of it, and maybe even on the services side of it, some pullback from the consumer. And they may actually need to do that because we're looking at savings that have actually dropped to 30-odd% below a year ago level. That's an amazingly stark decline. And with incomes slowing in their rate of rise, I don't see how they're not going to be pulling back in some of this consumption. For real personal income, excluding government payments, the 312 declined to just 1.8%. This is seasonally adjusted annualized data. So the 312 is the relevant measure there. And that 1.8%, that's running noticeably below the 10-year average, which is 2.6%. So real personal income has slowed considerably from what we were seeing even a year ago. And when we look at disposable personal income, so that's after-tax income, that 312 has weakened all the way to 1.3%. And the 10-year average there is 2.7%. So we're looking at half the 10-year average rate for after-tax income growth. And that's bound to show up in some of the sales data and even in the housing data. More on that in just a moment. The personal consumption price index, excluding food and fuel, which is what the Federal Reserve looks at when they're trying to gauge inflation pressures, stayed flat from last month at 2.7%. That's actually good news. That's not a bad number at all. With the slowdown that we're talking about here, including in incomes, we're likely going to see the personal consumption expenditures price index shows some more weakness as we move through the second half of this year. Again, that bodes well toward leaning towards seeing some interest rate decline. So don't give up on September. It may very well be later, but I don't think it's going to come sooner than September. But the data is leaning in that direction as we speak. I want to invite you to join Lauren Seidel-Baker and Lindsay Warnham. So by the numbers, they'll be recording that on June 3rd. It'll be out on demand for subscribers June 4th, and you'll be able to take a look at it, at least get the preview of it online the very next day. So take a look. They've been doing very good work. Recently, they took apart investing in gold and offered some interesting perspectives there. So it's worth your while. Thank you for joining us for this edition of FedWatch.